We will be explaining the construction of line, bar, candlestick and point and figure charts. Although there are other methods available. These are 4 of the most popular methods for displaying price data. Line chart. Some investors and traders consider the closing level to be more important than the open, high or low. By paying attention to only the close, intraday swings can be ignored. Line charts are also used when open, high and low data points are not available. Sometimes only closing data are available for certain indices, thinly traded stocks, and intraday prices. Bar chart. Perhaps the most popular charting method is the bar chart. The high, low and close are required to form the price plot for each period of a bar chart. The high and low are represented by the top and bottom of the vertical bar, and the close is the short horizontal line crossing the vertical bar. On a daily chart, each bar represents the high, low and close for a particular day. Weekly charts would have a bar for each week based on Friday's close and the high and low for that week. Bar charts can also be displayed using the open, high, low and close. The only difference is the addition of the open price, which is displayed as a short horizontal line extending to the left of the bar. Whether or not a bar chart includes the open depends on the data available. Bar charts can be effective for displaying a large amount of data. Using candlesticks. 200 data points can take up a lot of room, resulting in a cluttered chart. Line charts show less clutter, but do not offer as much detail, no high-low range. The individual bars that make up the bar chart are relatively skinny, which allows users the ability to fit more bars while keeping the chart comparatively neat. If you are not interested in the opening price, bar charts are an ideal method for analyzing the close relative to the high and low. In addition, bar charts that include the open will tend to become cluttered more quickly. If you are interested in the opening price, candlestick charts probably offer a better alternative. Candlestick chart. Originating in Japan over 300 years ago, candlestick charts have become quite popular in recent years. For a candlestick chart, the open, high, low and close are all required. A daily candlestick is based on the open price, the intraday high and low, and the close. A weekly candlestick is based on Monday's open, the weekly high-low range and Friday's close. Many traders and investors believe that candlestick charts are easy to read, especially the relationship between the open and the close. Hollow candlesticks form when the close is higher than the open, and filled candlesticks form when the close is lower than the open. The rectangular portion formed from the open and close is called the body, hollow body or filled body. The lines above and below are called shadows and represent the high and low. Some candlestick charts use color to show the relationship between the close and the previous close. Point and figure chart. All the charting methods mentioned before plot one data point for each period of time. No matter how much price movement occurred, each day or week represented as one point, bar, or candlestick along the time scale. Even if the price is unchanged from day to day or week to week, a dot, bar, or candlestick is plotted to mark the price action. Contrary to this methodology, point and figure charts are based solely on price movement and do not take time into consideration. There is an x-axis, but it does not extend evenly across the chart. The beauty of point and figure charts is in their simplicity. Little or no price movement is deemed irrelevant and therefore not duplicated on the chart. Only price movements that exceed specified levels are recorded. This focus on price movement makes it easier to identify support and resistance levels, bullish breakouts and bearish breakdowns.